Hello. We are going to investigate. Basically, we're going to investigate the portfolio of the correlation matrix that we did with the portfolio of several assets. Was Apple, Tesla, SPY, AGG, VNQ, and GLD. We did that in Chapter 6. So we're going to use the Ethnosoft platform that I introduced in the fall 2019. So I'm logging in, and here's the platform. It's loading up. And on my dashboard, I already have this a chart for Tesla. How do I get the chart for Tesla? Just in a particular field, I type in TSLA, and I press enter, and I have the Tesla. And the period is for 6 months, and it's a daily bars. In my class, I discuss how to interpret the bars for this price chart. So what we're going to do here is we're going to keep 6 months 1 day. We're going to compare it to first of all, Apple. So as you can see, the now it's not candles anymore, it's lines. It's called line charts. It's a time series, and they all start at 0. That's where, when you compare two assets, that's what you should do. Sort of do not look at them in terms of prices or levels anymore, but in terms of returns. They all start at 0%, and they all end up in their percent return. So you have percentage over here, percentage over here. So let's add, we have SPY. Which is S&P 500 ETF. Then we have GLD. Which is the gold ETF. Then we have AG. So the iShares Core US Aggregate Bond ETF. And if you remember, we also had a fifth asset that was real estate, and we had the Vanguard ETF. So real estate investment trust ETF that has real estate investment trust in its portfolio. So now we have overall six assets: Tesla, Apple, SPY, GLD, AGG, and VNQ. So remember that we said that in portfoliovisualizer.com that Tesla was quite volatile, and you can see that's actually right. In the past 6 months, look at the dip on Tesla. It's pretty much fell 30% in the span of from April 22nd all to June 3rd. In 1 month and 2 weeks, it's pretty much dropped 30%. Right here, minus 31% return. Look at what happened to Apple. Well, it also had a negative return, fell 15% from its original price in April. The index itself, SPY, S&P 500 ETF, dropped just a much more conservative 5%. But you can clearly see that this drop affected all of the stocks, including the index, in a negative way. Look at the bonds, the real estates, and the gold. They're all marginally higher. AGG was 2% for the period since April to May, and real estate was up 3%, and gold was 3.94, almost 4%. And you can see that gold pretty much took off throughout the period, while Tesla lagged, and Apple had a pretty good performance of 15% overall throughout the period. If you look at the real estate, it has 11% return, and the bonds obviously had a much lower 4% return, but that's why you have the bonds. They are a safe asset. So in this case, look at Tesla, for instance. It had a huge drop, but this drop never was not reflected in the prices of SPY or the prices of Apple. So it's clearly something else is driving Tesla's returns, aka prices in this graph. When you look at, for instance, VNQ and gold, you can see that gold was going up, VNQ was going down. So it seems like gold actually on the short term, not necessarily highly correlated with the real estate. And we should probably, if we could zoom in, we could look at the bonds versus the gold. We could probably find some positive correlation between them. But again, we have to look at the data. It all depends on what the data tells us. But it seems, so looking at the, if you look at this particular period when the stock market dipped, it's pretty clear that throughout the period, gold, bonds, and real estate, all this period, actually were not affected by the drop in the stock market. So it seems the correlation is actually, what the table told us, the correlation seems to make sense. Correlation between the gold, HGG, and VNQ, and on the other hand, with stocks, between sort of non-stock assets and the stock assets tends to be quite low. And that's what this graph tells us.